Hi there. Welcome to Clear Money Talk, where we turn complex financial topics into clear, practical insights. I'm Tim Clairmont.
And I'm Tyler Andrews. Welcome to the show. Let's jump in. Today, Tim, we're talking about when does it make sense to pay off your mortgage early?
Got it. Oh, this will be fun. That's I get that question a lot. A lot of clients are asking all the time. It's like, oh, should I put more towards this mortgage or not? Or they tell me I've been paying extra on my mortgage, and there's this sense of pride that they have when they share that with me, probably doing something that they believed they should be doing for a very long period of time. And the answer to that question is, I think generally speaking, you shouldn't beat yourself up if you are paying your mortgage off quicker. Even if the financials that I'm about to communicate to you might indicate that you could probably be growing your net worth faster if you pay off your mortgage at a regular pace, depending on where your interest rate is. We're going to talk about kind of where the line in the sand is and get some clarity around that. But the bottom line is, if you're paying your mortgage faster than your minimum, there's nothing wrong with that. It just might be a little more conservative from an investment strategy standpoint than you think you're being. And we can talk about pros and cons of that.
Yeah, that sounds great. And I think the genesis of this topic today really comes from, paying off your debt or paying off your mortgage early sounds like a smart move for a lot of people. And it can be in many situations. Less debt, more peace of mind, no monthly payment. But whether it actually makes sense depends more on, more than just the interest rate, which I think a lot of people use as the crutch of that decision. It's like, the interest rate's this, I'm going to pay it off quickly. If it's more like this, I'm going to hold that thing forever or as long as I can. So today we're going to break down when it makes sense to pay it off early, when it doesn't, what the trade-offs are, and some of the things that many people often overlook with those decisions.
Sounds fun.
Okay.
Well, maybe it doesn't sound fun to you. Maybe it sounds informative to you. But for us, we're nerds, so It sounds like fun.
This is what we do. This is why we're here.
That's what we do.
Let's talk interest rates.
Sure.
I think interest rates matter.
Yep.
It's not always the whole story, but low mortgage rates behave very differently than high rates. I think it's worth talking about that. Fixed rates versus an ARM, adjustable rate mortgage. There's differences there.
Yep.
And then also time remaining on a mortgage can also be a huge factor for it too. Are you early into a new loan, whether it's a 30-year conventional, a 15-year, or are you getting towards the end of a loan? And maybe that will sway your decision there. So,
And we could also discuss interest-only payments versus amortized payments and what the significance is there, as well as things like a home equity line of credit or a second mortgage if you have that on your home. So all of those elements tie into that mortgage concept and whether or not it makes sense to pay it off first. Let's give you the easy button answer first. I would say the very first thing to do is to look at your interest rate. And there's certainly a lot more that goes into it other than your interest rate, but the interest rate's the first place to start. And you might be feeling bad because you feel like your interest rate is particularly high right now if you bought a house or refinanced a home in the last, let's say, year and a half, relative to where it was previously. You might be sitting on an interest rate that's in the sixes or even the sevens. And if you're at an interest rate in the sixes or sevens, you might be thinking, I remember when rates were down in the threes or the fours. And you feel bad about that higher interest rate. But recognize that long-term historical rates-wise, rates in the sixes and sevens are actually not that bad. There was a period of time where rates were in the teens, and that was extremely painful for people that were dealing with mortgages. So, the higher your interest rate is, for example, if you theoretically had an interest rate like 10 or higher, the more important it is for you to pay that off or refinance it. Get that debt into something that's in a lower position than such a high rate. But if your rate's in the sixes and sevens, all this is a math calculation, and that's what it comes down to from an interest rate standpoint. We have to look at something called, it's actually the inverse of the tax equivalent yield. Whatever your favorite LLM is, whether it's ChatGPT or Claude or whatever, or Perplexity, or if you just want to Google this stuff, there's ways for you to analyze this on your own on a smartphone or otherwise. But what you would want to type in is, help explain to me what tax equivalent yield is. And you'll get all kinds of additional explanations. Bottom line is when you invest in a hypothetical product and you get a rate of return, let's say you get a rate of return of 7%. If that 7% is tax-free, because it's in theoretically some kind of a municipal bond portfolio or something along those lines, then you want to look and say, what rate of return would I need to earn in a taxable account to equal that 7% tax-free return. And depending on your tax bracket, which is something you'd have to look at, you can calculate something called tax equivalent yield. Now, you don't need to spend a long time nerding out on that. Let's just put that in a box, because ultimately what we're talking about with your mortgage rate is the same concept. The concept here is you have to answer the question, how much of your mortgage is tax deductible to you? If your mortgage is deductible to you and you can write off all of it on your tax return, which is something you should verify with your accountant or double check with a tax expert, because you might believe that, but maybe that's not true. It depends on your actual tax return. You really need to look close. But let's assume that it is deductible for you. That, let's say 7% interest rate, if it's deductible, and you're in a high tax bracket, let's say maybe you're in a 24 or 31% federal bracket. If you happen to be in Oregon or California, you're probably at a 9 or 10% state bracket. That means roughly 41% of your income tax consequence could be offset with a tax deduction if you had a 10% bracket or statewide plus a 31% federal bracket. What that means is take that 7% rate of interest on your mortgage, and you take that and multiply it by 0.59 to get what your tax equivalent actual rate is that you're paying, because it's like the state of California or the state of Oregon and the federal government are subsidizing your mortgage payments. That's effectively what's happening when you get a tax deduction. And so you're not really paying that full 7, they're paying a piece of it, and you're paying about 60% of it if you're in that tax rate. So if we do the simple math, 60% of 7% translates to approximately 4.2%. So you're looking at about a 4.2% after tax equivalent benefit as far as that, or I should say not benefit, but cost, true cost. Now the question comes down to, okay, well, if you took your money and you invested it in some kind of alternative investment, how confident are you that you're going to earn a 4.2% rate of return or higher? If you believe you're going to be able to take that money and earn a 4.2% rate of return or higher, then you can go ahead and invest that money instead of paying down your mortgage faster, and your overall net worth should grow at a faster rate because your investment performance on that investment should be greater than the 4.2. However, you also have to factor in the tax equivalent yield on that investment. So it does get a little heady, a little nerdy. Let's just take a step back and make it simple. If your interest rate is like below 5, whether it's deductible or not, that's a pretty low rate. You could probably just pay the minimums and focus on putting your money in something else if you have a good investment option available to you. Alternatively, if your interest rate's, let's say 7 or 8 or higher, probably makes sense to go ahead and pay down your mortgage as aggressively as you can, or look into refinancing that debt elsewhere, especially if your tax rate happens to be lower than that 31% federal level. If you're in the 22, for example, or you're in a state that doesn't have a state income tax, the tax benefits for you are less significant, so that higher interest rate is more costly.
Yeah. That was a lot of really good.
Sorry, it's really nerdy.
No, it was good. And I think it ties in very nicely, Tim, with the interest rate discussion where, interest rates are important, but they're not always the whole story. And I use this analogy with people all the time, is that you kind of have finance and money in a vacuum where everything's perfect. There's not a lot of variables. It is what it is. The numbers are really swing the decisions that we make. And then you have finance in real life where emotions really count and just how it makes you feel counts. In vacuum, those things don't exist, right? It's like you're in space and you don't have the wind and the storms of the weather that you do here on planet Earth. And when it comes to finance in a vacuum, it's like, yes, we need to look at the after-tax equivalent yield. We need to look at the interest rate and see how we can arbitrage those two to benefit us and our net worth to grow our assets over time. But then you have finance in the real world, and that's where it's like, what is your stomach telling you? Are you having trouble sleeping at night because you have this debt over your head? And that's where the question can be totally different based, person to person on how they answer that and how they address it for their unique situation. So
you're spot on. Actually, the 6th principle of financial planning has just come out in the last couple of years, and it's behavioral finance. And when you think about the impact that you have from an emotional standpoint, your attitude, your behavior is a significant part of the picture. For example, you might be very emotionally motivated to pay off your mortgage. Now, maybe your mortgage interest rate happens to be something in the 5s or 6s, and you're thinking, well, maybe I should take this money and invest it somewhere else. Well, if you're paying an extra $1,000 a month down on your mortgage because you're driven to get your mortgage paid down, and all of a sudden, from a math standpoint, you realize, well, I could take that $1,000 and invest it over here, and then I might make a higher rate of return. While that might be true mathematically, the reality from a behavioral finance standpoint is you may not be as motivated to invest that money over here. So if you stop paying $1,000 a month down on your mortgage and you start investing $1,000 a month, and then a month or two later you're like, yeah, $500 a month's good enough, and you cut down your contributions, well, your overall net worth is growing much slower than it would have been had you been paying down the mortgage faster with that higher dollar amount. So leaning into where your psychology is motivating you is actually a really, really healthy thing. And you want to give that some consideration. If you're going to take that same dollar amount and you're, robot android-like, which I can be sometimes when it comes to the math on this, if you can be robot android-like and truly take $1,000 here and move it here and make sure it's not going to change and it doesn't matter at all from an emotional standpoint to you, you just want to do the thing that's smartest and gives you the highest net worth, you can do the nerd analysis we talked about earlier with those rates of returns and the tax equivalent yield and figure out how you're going to optimize your growth. But if you have a human element to you that is pulling you into paying your mortgage off and it feels better to pay that extra money and you like doing that and you are doing that and you're not as likely to save the same amount of money somewhere else, lean into the thing that you're spending, putting more money towards the debt on, because pay that mortgage down faster. That might make a lot more sense in your case.
Yep. Thank you for adding those additional details on that, Tim. You hit on taxes. I think it's important to go back to tax considerations. I think there's a common misconception that mortgage interest deduction is more powerful and impactful than many give it credit for nowadays. With the standard deduction being so high, a lot of people aren't truly seeing the benefit of the mortgage interest deduction like they used to when they were itemizing on their Schedule A as an addition to their 1040s, filing their tax returns, and it's a lot different nowadays. Many people aren't seeing the benefit of doing that. So that helping move the lever, if you will, one way or the other on your consideration to keep a mortgage or to pay it down aggressively or pay it off altogether doesn't have the same ROI, if you will, that it used to. And I think it's probably worth sharing a minute or two on that, Tim. Any additional thoughts?
You're spot on. And you might believe that your interest is deductible on your mortgage, but it may not be doing as much work on your actual taxes as you think it is. And that's a very important, disconnect. You have to get to the heart of how much is your interest really affecting your tax return, and how much are you getting to take as a tax deduction. Tyler hit it on the nail on the head there, because the standard deduction is much higher now. Thanks to the tax reform we had happen a few years back, we all get to write off a certain amount of money just for being alive in the United States. That's basically what a standard deduction is. And itemized deductions is an alternative calculation. It's when you fill out what's called Form Schedule A and you itemize your expenses. There you get to itemize things like state and local taxes, as well as your mortgage interest. When you add those together, then you compare those to the standard deduction that you would have otherwise received. If your itemized deductions are less than your standard deduction, then you're going to get your standard deduction anyway, and all those itemized deductions do zero for your tax return, which means that if you're not itemizing anymore, if you went through 2024 and 2023 and 2022 and you're like, oh, I don't have to itemize anymore, that was kind of an interesting little ha-ha moment. Well, what that really means is you get zero tax benefit for your mortgage. Because if you're not itemizing and the standard deduction is greater, net effect is the mortgage interest expenses is not benefiting your taxes at all. And if it's not benefiting your taxes at all, that little adjustment we did earlier, where you had that 7% rate of return, mortgage rate, and you adjusted it for taxes and it became like 4.2, and you were comparing a 4.2. Well, after you adjust it for taxes, if you're not getting any deduction at all, you don't get to reduce the 7. It's a real 7. It's costing you 7. And that makes it much more important to pay down your mortgage in your situation. So your overall taxable income and where you sit on your Schedule A, whether you're itemizing or not itemizing, is definitely something that's going to factor in. And realize with the recent tax reform just this last year in 2025, they've increased what's called the state and local tax limit, SALT, S-A-L-T. And that state and local tax limit previously, as a married couple or as an individual, you were capped out at a maximum of $10,000 that you could itemize when it came to your personal property taxes on your property, plus your income taxes, including state income taxes. And by the way, if you're in the city of Portland and Multnomah County, you have Multnomah County income taxes. All of those were limited to that $10,000 threshold. The tax reform last year that just took effect bumped that up to $40,000. So now you can actually write off up to $40,000 of state and local taxes, which right there in and of itself will be greater than your standard deduction if you happen to have taxes at such a high level. Thus, your mortgage interest may not have been deductible to you in 22 or 23 or 24, and all of a sudden now when you do your 2025 returns, you might be able to itemize again, and the Schedule A itemization might actually result in a deductibility of your mortgage interest that you didn't have in previous years. So you got to nerd out a little bit and pay attention to these things in order to make sure that you're looking at it year by year by year. Each year is a different game with different rules, and you've got to adjust your plan based on those rules to legally minimize taxes and optimize your personal net worth growth.
Love it. Thank you for bringing that up, Tim. That was like tickling the back of my brain. I was like, I know we need to mention the SALT limit that just increased last year. So thank you for bringing that up. I think that's a great point of clarification there, as well as everything else you said. And yeah, I think don't use the tax justification to make your decision on whether to keep or not keep a mortgage. Like it doesn't have the power that it potentially used to, the deductibility of your mortgage interest. So don't use that as the crutch to keep or get rid of it. Look at the additional factors that we've talked about so far and that we'll continue to talk about as this podcast continues to unravel. You ready for the next stuff, Tim?
I love it. Unravel. It's like, we're going to go crazy. All right. Yeah, let's go. What else? Backfill.
When does it make sense to pay off a mortgage early? I want to hit on some of those topics that I have written out here, and we can share our thoughts on them.
Yeah, I think it makes sense. Obviously, the higher interest rate is a good reason to pay off your mortgage early, but it's definitely not the only reason to pay off your mortgage early. The second one we already talked about was that motivation that you might feel emotionally to pay your mortgage off early. Getting rid of debt is not necessarily a bad thing. It's almost always a good thing. It's just a function of, the less you owe, the more your net worth can grow. I like that. That rhymes. The less you owe, the more your net worth can grow. Quote. Hashtag.
For most people, I would say that is absolutely the case. You can strategically use debt to increase your position and increase your net worth. Done well, but you have to have a high risk tolerance for that. And a lot of people have preference for more certainty, and with more certainty comes lower debts and paying those things off. But one of the most common ones that people use as the justification for paying off a mortgage early is entering or approaching retirement. This is the big one. I think this is almost the part of the American dream. Yeah. Working hard, doing the right stuff for a long period of time, finally reaching that milestone where you can say, you know what, I'm going to hang up my boots, I'm going to retire and do what I want to now with my minutes, which is so important, and we love that. It's what we do. But with that comes a huge desire and dream to pay out the mortgage, whether it's paying it off the second you enter retirement because you've been saving and you have a huge down payment of cash that you can deploy for that strategy, or that you've timed your retirement strategically to align with when your mortgage is fully paid off. I think that's a great North Star to shoot for, and the implications of that is worth at least a couple seconds of our time.
It is totally. I got to tell you, Tyler, my brain is just like in a fog right now. I'm still stuck on the analogy that you just shared of hanging up your boots. I've never really thought of hanging up boots before.
You got your work boots.
What is that? I get that.
And then you go put the tennis shoes on.
Okay, all right. But I have never hung them. Like that's an interesting visual. So all right. It's all good. I'm just giving you a hard time. So anyway, I'm distracted with the hang your boots analogy. But yeah, it's sometimes it does. If you're going to retire soon, it makes sense for you to go ahead and seriously think about, is that your American dream? Is that what you were raised to believe, or is that what you've come to believe? However that might be the case, at the end of the day, if you feel like having a house paid for is a part of your American dream and part of your retirement vision, then yeah, you're going to need to get that thing paid off. Don't take that money out of a pre-tax qualified retirement account to do that, though. Make sure that you're not looking at like your 401k or your pre-tax IRA account and thinking, wow, that's so great. I only owe $150,000 on my mortgage, and when I retire at 64 or something like that, I'm going to take this $150,000 out of my retirement account and pay off my mortgage. Really bad idea. That pre-tax retirement money that's in that retirement account, if you take it in big lump sums, you're going to add it on top of your income that year and pay really high income tax rates on it. So you might actually have to take out something like $200 or $250 to get $150 to pay off your mortgage. Not the most efficient use of those resources. So paying it off along the way out of your normal paycheck with after-tax money, or paying it off with after-tax money from some other source, better kinds of money to pay off your mortgage with. Do not try to pay off your mortgage with pre-tax money and a very large contribution because it'll require a large distribution that'll be subject to significant taxation.
That's right. Yep, great point. So when does paying off a mortgage early often make sense? Also, when you have strong cash reserves already in place. So we have clients come to us all the time that they're just diligent savers. Maybe they have more coming in than they're spending. Maybe they've received an inheritance. Maybe they won, a hand of blackjack, or they won, they had some sort of a windfall.
It's a big blackjack hand.
Yeah, you know what? If you want to win big, you got to play big.
Yeah.
That is not advice to gamble.
Not advocating for gambling.
No.
So it does remind me of an episode of Landman that I saw recently, though, but I'm not going to ruin it for all of you out there. So anyway, please continue.
Yeah. But we have clients come to us all the time when they've hoarded a large amount of cash, and they say, you know what, I have all this extra cash. What are some smart things we can do with it, guys? And paying off a mortgage usually comes up in that conversation if they still have a mortgage outstanding at that point in time in their financial journey. And it's going to be very situational depending on if it makes sense to do that or not. But there are some benefits of doing that. There are also some benefits of even maybe not paying off the mortgage altogether, but paying it down partially. That's something that you can do too. So many people don't realize if you do a principal-only payment against your mortgage with some of your extra cash reserves, let's say your interest rate on your mortgage is a little bit higher than you would want, that line in the sand that Tim was talking about earlier, and you want to deploy some of that cash to pay down that mortgage, you can actually do what's called a recast or a rebroadcast, some people call it. And you can then reduce your minimum payment for the remainder of your mortgage term duration to lower your payment moving forward, which can be a smart thing to do with some cash if you have it, whether it's paying it off in full or doing that partial that I was just talking about.
Solid points. At the end of the day, if cash flow is a crunch for you in retirement, which it is for the majority of Americans, let's be real. I mean, that's the reality. Most people don't have enough to retire on comfortably in the United States. But the vast majority of Americans are struggling as it relates to trying to figure out how they're going to make ends meet when they go to retire. And if you have a high mortgage, you might even be thinking, I'm going to sacrifice more years of my life working to get that thing paid off in the next few years and work between 63 and 66, for example, or 65 and 68, or 65 to 70, and you're giving up years of your life to try to pay off a mortgage, when in reality, you might have had the opportunity to simply do a recast, like what Tyler was talking about, and accept the fact that you're going to have a very low mortgage if it takes that little bit that you owe left that you're going to pay off in the next few years and stretches it over a new 30-year period. You won't get that paid off mortgage that you wanted to have, but your minimum payment on top of your property taxes might allow you to retire and gain 2 or 3 years back of your life and be able to retire much earlier. These are all the kinds of strategies and insights that we share with our clients all the time. Sometimes looking at the same puzzle pieces changes the way the puzzle gets put together, and that's what we're experts in, or I should say, we're really good at.
Yeah, that's right. Okay, when does it not make sense to pay off a mortgage early? One of the biggest ones is limited emergency savings. So that's where the basis, that's the benchmark, that's the foundation of all smart financial decisions, is before you can say, let's start investing and doing other things with my money. It's let's make sure we have bad debts paid off. Mortgage usually isn't coined as a bad debt. Usually it's coined more of a good debt, if you will, or somewhere in that realm. But emergency savings is so important, and having that buffer there, so if anything does go wrong with your situation, whether it's a loss of a job or medical emergencies or anything like those happening, that you have a buffer in place to dip into, and not have to dip into other things that might not be as strategic for that time and place. So having adequate emergency savings, everyone, that's going to be different. Some people, it's a very large number. It's a very personal and emotional decision for each household and each person that we deal with. But usually the good rule of thumb is anywhere from 3 to 6 months of living expenses. Somewhere safe, checking, savings, high yield savings accounts, a CD, money market accounts. Usually those cash and cash equivalents are a good place to have that. But if you don't have that already built up, if you don't have that buffer in place, that emergency fund, usually it's not going to make sense to deploy extra amounts of cash that you have on hand towards paying off the mortgage early if you haven't already built up that emergency savings that we're talking about.
Smart stuff. Yeah, all of that's on point.
Yeah.
You know, when I think about the majority of people listening to this podcast, you probably fit in one of two groups. You're either like the majority of Americans, which unfortunately it's a struggle, and you have cash flow challenges and cash flow crunches. And for you, my phrase that I said earlier is on point. The less you owe, the more your net worth can grow. You probably want to get rid of your debt for the majority of Americans. The minority of Americans who have enough wealth that they're going to be okay financially, that's the typical client that we work with on a regular basis. And in that scenario, it's about net worth optimization. And in that scenario, it might make sense to not pay off your mortgage fast because you might have a low interest rate. You might be in a higher tax bracket. You might have a lower net tax consequence on, or I should say lower net rate interest rate because of that tax equivalent calculation that we talked about earlier today. And you might even want to take advantage of that debt to optimize growth of your overall net worth by not paying it off. There's a concept called leverage. People call leverage, it's synonymous with debt in a lot of investment terms. And just like you can imagine if you have a large stick and so like a boulder that you're trying to move, that large stick, you can have a small amount of force pushed down on the stick, but because of the power of that leverage and how long the stick is, you can move a giant weight. The same thing can happen when you're dealing with financing and using leverage at low interest rates so that you can take somebody else's money that they're loaning you on lower interest rate amounts, invest it in other places where you're earning a higher interest rate and benefit from that difference, also commonly referred to as arbitrage, but a little bit more complicated. If you're in that camp, then forget about what I said about the less you owe, the more your net worth grows. If you're in the majority of Americans' camp, then the less you owe, the more your net worth grows. So try to pay off your debts and take care of things, and hopefully that helps you differentiate a little bit better as well as some of our guidance.
Yeah, I think that's a great point. I think the longer your time horizon is and the lower your mortgage rate is, the more it likely makes sense to retain that mortgage and use your income and your other assets to do more for you outside of dealing with the mortgage.
Yep.
Which is important. And also, if you need liquidity, I don't think paying off your mortgage early is likely a good use of your additional liquidity. If you need it for other stuff, you probably should use it for the other stuff opposed to paying off your mortgage early. I think that puts us at a good point there, Tim.
I concur. I think we need to wrap this up and get to just the answer.
Okay.
As far as the just the answer is concerned, you want to jump in or you want
love to? Yeah, let me rephrase the question for us on just the answer. Always recommend listening to the full episode. I'm impartial because, or I am partial because, Tim and I have such a great time doing it, and there's a lot of good content on there. But if you're tuning in for the time savings sake, just the answer here for you. We talked about when does it make sense to pay off your mortgage early. Tim and I talked about a slew of different things. First being the financial trade-offs. People often miss out on whether to pay it off early or not. We talked about interest rates matter. They're always not the whole story, though. So we talked about fixed rates. We talked about adjustable rates. We talked about different mortgage types, conventional and otherwise. We talked about time remaining on a mortgage can also be a big impact of whether you're going to pay it off early or retain it. So definitely listen to the full episode to get more key details there. Tim and I also talked about tax considerations. Do you want to add any details on this one, Tim?
Yeah. Keep in mind that the deductibility associated with your interest on your mortgage is a key element of the calculation when you're trying to make this determination as to should you pay off the mortgage or should you not pay off the mortgage. And the tax deductibility has changed significantly just with 2025. It's very possible that you were not itemizing your deductions in 2022, 23, 24 because the low SALT limit, state and local tax limit at $10,000. Now that it's at $40,000, it's possible that you're going to be able to itemize your deductions again. They'll exceed your standard deduction, and that might make your mortgage interest deductible in 2025 where it possibly wasn't in 2022, 23, 24, which changes the calculation as it relates to opportunity cost.
That's right. Thank you, Tim.
Yep.
We talked about when paying off a mortgage early can make sense. It's going to be unique to each person and their situation, but a lot of the times the situations that do make sense for paying it off early can be approaching or entering retirement. That's a big one for many clients that we see on a day-to-day basis. If you already have strong cash reserves in place and you're looking for other things you can do with some of that extra cash, smart things, one of those might be paying off a mortgage early or paying it off in portions. Desire to reduce fixed expenses. So if you were trying to reduce expenses overall, especially those fixed or non-discretionary expenses, those expenses that pop up every month regardless, paying off a mortgage early or doing a recast by doing a partial pay down on your outstanding mortgage balance can be a smart strategy in many situations. We also talked about low risk tolerance or more preference for certainty in your life. If you have a low risk tolerance, debt's just not your thing. Paying off a mortgage early might make sense for you. And that might be something to consider. When it doesn't make sense, Tim, we talked about limited emergency savings. And please, if you want to add anything, Tim, you're more than welcome.
No, I mean, considering it's just the answer, we got to keep it tight. So at the end of the day, if you want to listen to more, listen to the whole version of the show. There's a lot of stuff we talked about, and there's even some stuff we didn't get a chance to get to, even in the full version. So If you're looking for just the answer, I get it. I would love to give it to you that simple, but and the bottom line is, it's generally speaking not a bad idea to pay down your mortgage earlier for a lot of good emotional reasons and your own motivations, and especially if you're at a higher interest rate. If you're at a lower interest rate, it might make sense to hang on to that, but it might still make sense to pay off your mortgage earlier depending on your emotional feelings. So factor that in and listen to the whole version of the show if you want to get all the details and frankly have a good time.
Agreed. That's a nice wind down there. You ready for some trivia, Tim?
Yeah, sure. Hit me. What do you got for me today? Okay. Stump the nerd. Here we go.
Stump the nerd. Ties nicely into our topic.
Okay.
Tell me, Tim, roughly how many Americans reach retirement and they're still carrying a mortgage?
Oh, like as a percentage or as a number? As a percentage. The percentage of Americans who reach retirement.
About this much percent.
Well, interesting, because if you're including all the Americans that don't own a home, that are renting, like those would, if they added into the mix, then that would represent, did they count as didn't pay off a mortgage because they don't own a home that's paid for? Or do they count as, they don't have any mortgage on their house, therefore they don't count against that particular number? Or perhaps they were simply excluded. Let's just go with, I agree. Let's just assign a percentage to it and say, let's just say that if the renters are excluded, which is probably the case for this kind of a question, if you own a home and you have a mortgage or don't have a mortgage, I would say it's probably 65% would be my guess that still have a mortgage and have not paid it off. So maybe 35% pay it off. That'd be my guess.
It's a decent guess.
All right.
Yeah, it's about 45%.
Okay, so 45% still have a mortgage?
That's right.
Maybe if it's 45% still have a mortgage in retirement, maybe they're including all those renters then that don't have a mortgage, and that's bringing that number down.
You can spend time.
I'm rationalizing.
Your own time
I have to go to 45%, so be it.
If you're still carrying a mortgage into retirement, congratulations, you're extremely normal. About half of Americans when they reach retirement are still carrying a mortgage. So
there you go. All right. Thanks for joining us today on Clear Money Talk. Hope you learned some good, smart stuff, practical, actionable insights. And if you want to learn more, check out some of our other episodes on Clear Money Talk. If you feel like you might be a good fit for somebody who can work with us, don't hesitate to reach out. You can connect with us at 503-579-1000 or check us out on the internet at clearfp.com.
Yeah. And if you found value in the episode, which I hope you did, consider subscribing so that way you don't miss future episodes, and also consider sharing it with a loved one or friend or a coworker so that way they can gain some of the actionable insights that we have to share every other week for you guys.
That's a lot of calls to action. Bottom line, subscribe. Thank you.
See you next time.
Bye-bye.
Tim Clairmont and Tyler Andrews are investment advisor representatives offering securities and advisory services through Cetera Wealth Services, LLC, member FINRA SIPC. Advisory services offered through Cetera Investment Advisors, LLC, a registered investment advisor. Cetera is under separate ownership from any other named entity. The views depicted in this material are for information purposes only and are not necessarily those of Cetera Wealth Services, LLC. They should not be considered specific advice or recommendations for any individual. Cetera Wealth Services, LLC exclusively provides investment products and services through its representatives. Although Cetera does not provide tax or legal advice or supervise tax, accounting, or legal services, Cetera representatives may offer these services through their independent, outside business. This information is not intended as tax or legal advice. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. Examples referenced are hypothetical only and do not represent the actual performance of any particular investments. Converting from a traditional IRA to a Roth IRA is a taxable event. A Roth IRA offers tax-free withdrawals on taxable contributions. To qualify for the tax-free and penalty-free withdrawal or earnings, a Roth IRA must be in place for at least 5 tax years, and the distribution must take place after age 59.5 or due to death, disability, or a first-time home purchase, up to a $10,000 lifetime maximum. Depending on state law, Roth IRA distributions may be subject to state taxes. Distributions from traditional IRAs and employer-sponsored retirement plans are taxed as ordinary income and, if taken prior to reaching age 59.5, may be subject to an additional 10% IRS tax penalty. Investors should consider the investment objectives, risks and charges, and expenses of mutual funds and ETFs carefully before investing. The prospectus, which contains this and other information about the funds and ETFs, can be obtained directly from the company or from your financial professional. The prospectus should be read carefully before investing or sending money. A diversified portfolio does not assure a profit or protect against loss in a declining market. Dollar cost averaging will not guarantee a profit or protect you from loss, but may reduce your average cost per share in a fluctuating market. Investors cannot invest directly in indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees fees, and expenses associated with investing. Although it is possible to have guaranteed income for life with a fixed annuity, there is no assurance that this income will keep up with inflation. There is a surrender charge imposed generally during the first 5 to 7 years or during the rate guarantee period. There is a surrender charge imposed generally during the first 5 to 7 years that you own the contract. Withdrawals prior to age 59.5 may result in a 10% IRS tax penalty in addition to any ordinary income tax. The guarantee of the annuity is backed by the financial strength of the underlying insurance company. Investment subaccount values will fluctuate with changes in market conditions. An investment in a variable annuity involves investment risk, including possible loss of principal. Variable annuities are designed for long-term investing. The contract, when redeemed, may be worth more or less than the total amount invested. Variable annuities are subject to insurance-related charges, including mortality and expense charges, administrative fees, and the expenses associated with the underlying sub-accounts. Investors should consider the investment objectives, risks, and charges and expenses of the variable annuity carefully before investing. The prospectus contains this and other information about the variable annuity. Contact Clear Financial Partners at info@clearfp.com or 503-579-1000 to obtain a prospectus, which should be read carefully before investing or sending money. The cost and availability of life insurance depend on factors such as age, health, and the type and amount of insurance purchased. Before implementing a strategy involving life insurance, it would be prudent to make sure that you are insurable by having the policy approved. As with most financial decisions, there are expenses associated with the purchase of life insurance. Policies commonly have mortality and expense charges. In addition, if a policy is surrendered prematurely, there may be surrender charges and income tax implications. The target date of a target date fund may be a useful starting point in selecting a fund, but investors should not rely solely on the date when choosing a fund or deciding to remain invested in one. Investors should consider funds' asset allocation over the whole life of the fund. Often target date funds invest in other mutual funds, and fees may be charged by both the target date fund and the underlying mutual funds. The principal value of these funds is not guaranteed at any time, including at the target date. Cetera does not offer any direct investments, endorsements, or advice as it relates to Bitcoin or any other cryptocurrency. This is for informational purposes only. Bank certificate of deposits are insured by an agency of the federal government and offer a fixed rate of return, whereas both the principal and yield of investment securities will fluctuate with changes in market conditions. Clear Financial Partners is located at 15573 Bangui Road, Suite 100, Lake Oswego, Oregon 97035. For more information, please call us at 503-579-1000.